Hello everyone, this is Randall from the Penguin Syndicate. Today we're taking a clear look at the most recent US government shutdown. What happened, why it mattered, and how the markets reacted across stocks, forex, and crypto. No drama, no noise, just facts. Let's begin with the core definition so we're all on the same page. A US government shutdown happens when Congress fails to approve funding on time. When that deadline is missed, many federal agencies pause operations. Employees get furloughed and normal economic data releases are delayed. It's not rare. Shutdowns have happened repeatedly over the past decades, and each one creates uncertainty across financial markets. Shutdowns usually come from political gridlock. Lawmakers can't agree on budgets, deadlines pass, and the government hits an operational wall. Markets dislike this because uncertainty about fiscal decisions immediately affects sentiment, risk-taking, and overall expectations for growth. One underappreciated effect of shutdowns is delayed economic data. Reports like CPI, jobs numbers, retail sales, and GDP may not be published on schedule. Without them, analysts and investors lose visibility. And when markets lose visibility, volatility increases. It becomes harder to price risk accurately. Shutdown headlines alone can move markets. Even before anything actually happens, traders position defensively. Stocks tend to weaken, volatility rises, and safe haven flows pick up. The psychological impact often matters more than the shutdown itself, especially in global markets that watch the US closely. The US dollar reacts in a very mixed way to shutdowns. Sometimes the dollar rises because global investors seek safety. Other times, it weakens because a shutdown highlights political instability. In the latest episode, the dollar showed choppy behavior, short-term swings without a strong direction, typical for uncertain macro environments. During a shutdown, companies tied to government contracts or regulated industries often experience sharper moves. Broader indices can hesitate while investors wait for clarity. Tech, financials, and energy sectors react differently depending on how long the shutdown lasts and which data releases get delayed. Treasury yields often fluctuate more than stocks. Investors shift between risk-on and risk-off expectations depending on progress in Congress. A prolonged shutdown can push yields lower as money moves into safe assets. But shorter shutdowns usually create only short-lived noise. Crypto often behaves differently from traditional markets. Shutdown uncertainty tends to increase short-term volatility. Bitcoin and Ethereum may spike, dip, or do both on the same day. Unlike equities or bonds, crypto markets aren't dependent on government data releases, which makes their reactions more sentiment-driven. Because the US is the world's financial anchor, a shutdown affects more than just America. Global markets react to delayed economic data, disrupted trade expectations, and shifting risk sentiment. European, Asian, and emerging market currencies and indices often mirror US uncertainty. The most recent shutdown followed the same playbook: political gridlock, rising volatility, delayed data, and global spillovers. But it also showed how resilient markets can be. Investors have learned to treat shutdowns as temporary headaches rather than structural crises, unless they drag on too long. To summarize, shutdowns create uncertainty, delay key data, and shake market sentiment across stocks, forex, bonds, and crypto. Even short shutdowns can leave noticeable ripple effects. Staying informed matters more than ever, and that's exactly what we aim to help with. This is Randall from the Penguin Syndicate. Thanks for watching, and stay tuned for more clear breakdowns of complex events.